Hey guys, welcome to the class today. Here at Life Designers, we're always trying to bring more value for your money and bring you content that's really going to make an impact and a difference in your life so that you have control over it and truly become a life designer. And so what we're going to talk about today is a concept called of being your own bank. And to kind of introduce this before we get started, if you were going to build a house, right? One of the things that first thing you'd want to do is build a strong foundation, because if you build a house on top of a faulty foundation, all it takes is a little bit of a shift in the ground, a little earthquake, a little storm, a little bit of something, and all of a sudden now the foundation has cracks or it's compromised and you risk losing the whole thing, right? So obviously building on a strong foundation is huge. And so financially speaking, if we want to build a financial house, what we need to do is be able to build upon something that's strong and solid. And so that when we take risks and other things in our lives, it doesn't crumble the house, right? So so what we're going to introduce you today with being your own bank is that foundational type of a plan that you can build upon, right? And that's one of the problems that most people have today is they don't have a strong financial foundation, and that's what Life Designers is all about, is being able to provide people with the resources available and needed to be able to create the life that you want, right? And design your life. And this concept right here can be an important part of the overall picture to build upon moving forward. All right. So with that, let's dive in. First of all, we got to talk about banks and what are they doing with your money, right? Well, if we deposit money into the bank, it really becomes their reserves. It becomes their money. Then they use it how they want to use it. So let's say we have this like local bank here. Let's just throw out a number. Let's say they have $100 million, and instead of lending out that 100 million in the way of mortgages, car loans, credit cards, things like that, what typically happens is they end up going to the Federal Reserve and they say, hey, can I use my money to back up a loan from you guys? And they say sure. And they send them over the money, right? And so what happens is now the bank has the 100 million that they have, and then let's just say there's 100 million here. Okay? They still don't lend out their money, because they need to make sure if you and I go to the bank and say, hey, we want to take money out of our account, they need to have the money and the resources there to be able to do so. So they keep their money and they end up lending out this money that they've borrowed. Okay? And so that's why when we borrow from the bank, they give us money with interest and this structured payment plan that you have to qualify for and all this kind of stuff, because they need to make sure that you can make your payment so they can make their payment, right? And so most people would agree that this is a very successful way to make money. That banks make plenty of money doing this, and type of a thing. So the question is, can we do it? Right? Are there companies willing to lend us money like the Federal Reserve does with the banks? And the answer is yes. Insurance companies are willing to do that. Okay. And so how this works is that you start to put money into your own account within the insurance company, and you start to build your reserves. As you build your reserves, what happens is that you have your account with the insurance company, and you have the insurance company. And let's say you wanted to make a purchase, right? Or let's call these books a student loan. Let's say you wanted to pay off a debt. Well, if this was a normal bank account, right, you would take the money out of your account and go pay off the loan. So you no longer have the loan, but you no longer have any money in your account, right? That's pretty straightforward. That's how it works. But what if you could pay off the loan and keep 100% of your money in the account? Well, this is how you're able to do that. You're able to say, just like the bank says, hey, Federal Reserve, you can say, hey, insurance company, can I use my money to back up a loan from you guys? And they say, sure, right? And they send you over the money out of their own pocket. You pay off the student loan, while 100% of your money stays in your account, continuing to grow and compound. Now the gotcha is that whatever the money they gave you here is now unspendable over here, but the key to the principle is that 100% of the money is still in your account, still growing, compounding, generating interest. correct? And so, anyway, that's kind of the basic principle. But the power of this is that borrowing from an insurance company is different than a bank. Because sometimes when we use the word borrow or loan or whatever, we think of debt and bad and whatever else. This is not. This is something totally different. Okay, and so although the insurance company still gives you money with interest, they're giving you this unstructured payment plan that you have to no qualifying, no credit, has nothing to do with any of those things. In fact, there's no required monthly payment. And in fact, if you do it the right way, you could actually have it pay itself back automatically when you pass away. Right? So I know that probably raises a few questions, but we'll probably answer those as we go along. And so since this has to do with, since the type of account with the insurance company is a life insurance policy, let's talk about it for a second. Let's talk about life insurance. And so if this was the insurance risk curve, age 0, age 100, and this is kind of the cost associated with that, it gets exponentially more expensive as you get older. There's three basic types of insurance. The first type of insurance is term, which was what most people have and most people are familiar with, where wherever you're at on this curve is where you start, right? And it's a fixed cost for X amount of years or a period of time or a term, right? 10 years, 30 years, the term of your employment, whatever the case may be, it goes along and then it stops. If you still want the coverage, you have to requalify and then pay some higher cost, right? On the other side of the coin, you have whole life, which is named appropriately because it covers you for your whole life, and it has a fixed cost as well, right? But compared to term, it's quite a bit more expensive. Whereas universal, on the other hand, is a hybrid of the two. It has more of a term-like cost, but also covers you for your whole life. As a result, it does have somewhat of an increase in cost over time, but not this exponential type of an increase you might experience otherwise. All right. And so if we were to put $100 in premium into these types of policies, now this is not 100% accurate to any one particular case. It's just to illustrate a point. Now, with a whole life policy, maybe you might pay like $80 of your 100 goes towards that life insurance, that death benefit that you are that you're getting with the life insurance policy, and 20 goes towards the savings. So you can build up cash within the policy that you can utilize. So this 20 here is what you could start utilizing potentially. It's going to grow up maybe 3 to 6% inside of this whole life policy. So a lot better than better interest than the bank, right? Whereas universal life, because the cost is structured differently, maybe you might pay something like $30 instead of $80, which leaves $70 to go towards the savings potentially. Okay, in a traditional universal, that 70 is going to get kind of the same 3 to 6%. Whereas with a term, you might pay 20, and as many people know, there is no attached savings to this, and so you don't. This is also where we get the phrase "buy term, invest the difference." Maybe some of you have heard that, maybe you haven't. But it's the idea that, hey, I'm going to take my $80 that's left, I'm going to pay the least amount as I can for insurance, take the difference, put it into, say, the market, and historically you're going to get, but most likely get better than 3 to 6% having your money grow that way, right? I would say it's a pretty sure thing that you'd get that more than 3 to 6% over time. Okay, but if I add the word indexed in front of universal, now I have indexed universal life. Now my 70 actually can grow based off of the market, that market index. Okay, and so when I say market indexes, I'm talking about things like the S&P 500, the Dow Jones, the Nasdaq. These are market indexes that we've heard of. Okay. Now, by combining that with the insurance policy, you actually get some additional perks that you don't get outside of doing that. And one of those is it's actually guaranteed against loss. Okay, so you can't go backwards. So you can get the growth without the market-based growth without the market risk that you typically take if you're actually in your traditional type of accounts. Now, the gotcha on the upside is there's usually some sort of cap or restriction. There's all kinds of various ways to do this, and insurance companies are pretty. There's lots of options, no cap options even. Okay, but I'm going to show you an example at 14.5%, and so because I want to illustrate that losing money hurts you more than making money helps you, right? So, because if we look at the market over the last 20 years, all the green years are all the down years, and there's only 6 of them. So there's only 6 down years out of 20, and a lot of these up years are well above 10%. Okay, so really good returns in the up years, very few down years. 100 grand invested turns into 218, you double your money. But if all we did was protect against the loss, right? If all we did was protect against the loss, right? And even if we capped out the gain, 14.5 versus 21, 14 versus 17, right? Even if we capped out the gain at the top, but the fact that we didn't lose anything, that turns into that 100 grand turns into 430. Right? You 4 times your money in this case, and the only real difference is that instead of losing here, you stayed flat where you're at, and when it starts growing, you're growing from here versus down here, just trying to recover what you lost. Okay? And so if we were to recap here for a second, first of all, you have this banking principle, which being able to utilize your money now the same way the banks do, etc., is, and then if the money that is in that account is in an account like this, where it can actually get market-based growth without the same market risks that you'd normally take, those two things combined are pretty amazing and pretty dynamic in and of themselves, right? But the real magic, so to speak, is in the fact of the power of taking a loan versus a withdrawal out of your account. Because if we took this kind of traditional investment, and we're just going to focus on retirement in this particular case, but if say someone put in $500 a month at 7% for 30 years, it would grow to $566,000. Now, if we let's say we're retired and we want to take $67,000 a year as an income, depending on taxes, that money would be gone in 7 to 13 years potentially, right? Whereas the money in an IUL, same money in, same number of years, everything being the same, let's say it even grows to less money because you had to pay some insurance cost along the way for that life insurance portion, so you get $523. But when we take that $67,000, instead of a withdrawal out of our account, we take a loan against our account, so we're not actually dropping the balance of our account. By doing so, that money ends up lasting the rest of our life potentially, all with the same money out of pocket, right? Now, I know that there's a lot of questions that you might have on this, okay? And but this is powerful. This is great stuff, to be able to utilize here. So now here's where the rubber meets the road. It's time to take action. It's time to legitimately start designing your life and start putting things in order and be able to achieve all the goals and dreams. Napoleon Hill, in the book Think and Grow Rich, said that all the successful people that he interviewed, all right, made decisions quickly and very rarely ever changed their mind, right? And so this is your opportunity to be able to make that choice, take that action. We'll set you up with a licensed professional who has been doing this for years and years, knows exactly how to help you, answer all your questions, and to be able to tailor a plan that is specific to you that you're going to be able to grow into as you're using all the other resources that Life Designers is presenting. The time is now. Right? Even if you're in debt, even if you're looking for other things, to get this information in your hands, to plan, to be able to have something that you can work towards if you're not ready right now is so important and key in making this whole life design possible and happen. So we look forward to hearing from you. Reach out 954-33-8624. You can call or text or send an email to banking@lifedesignersllc.com, and we'll talk to you later.